This is Jody Trana with Chapter 4, Part 1 of Business Finance. Raw numbers can be really interesting and helpful, but it can be even better to see relationships between numbers, which are ratios. For example, take a look at this information about enrollment at Union College. It's really interesting. But it might be even better to use some ratios to describe the relationships between the numbers. For example, it'd be really helpful to know the percentage of growth in student enrollment for this year compared to the previous year. It'd also be really nice to know the percentage of women versus men. It's also more useful to know that the teacher-to-student ratio is 9:1. These ratios or number relationships would allow us to compare one year to another year and our college against other colleges. Like this, the numbers are interesting, but not extremely useful. Common size financial statements are one way that we prepare numbers so that we can compare them easily with previous years, competitors, and other companies in industry. Here's a common size income statement. A common size income statement is an income statement in which each line item is expressed as a percentage of sales. You can see here that sales is 100%, and each number is calculated as a percentage of sales. So cost of goods sold is 75% of sales. The really useful numbers are our totals, like gross profits, being 25% of sales, and our bottom line net income, 7.6% of sales. This is the first page of a common size balance sheet, just the assets. As you can see in a common size balance sheet, all of the accounts are figured as a percentage of total assets. If you look at the bottom of the balance sheet of this assets section, you'll see that total assets is 100%, and all of the other account categories are calculated as a percentage of the total assets. So you can see that in 2016, we had 4.6% of assets is in our cash. This helps us to compare one year to the next. Here we have 2 years compared, and we can see the change where it has grown and where it has decreased. Here's the second page of the common size balance sheet. Just like the first page, everything is calculated based on total assets. And you know that total assets equals total liabilities and stockholders' equity. So everything on this page is calculated as a percentage of assets or as a percentage of total liabilities and stockholders' equity. Why are we looking at ratios today? Well, coaches and scorekeepers in sports, they keep many, many records and statistics. Quarterbacks are judged by their passing accuracy, which is also called the completion percentage. They're also judged by the number of touchdowns they throw, the number of interceptions, and the number of yards they gain by passing. In this graphic, you can see additional information and statistics on how Patrick Mahomes' pass percentage is rated based on different areas of the field and the yardage thrown. We aren't just looking at numbers here, we're looking at relationships between many numbers to tell a story. Now let's do some comparison. Let's compare Patrick Mahomes' passer rating with another quarterback. Here you can see Jared Goff's passer rating compared with the other quarterbacks in the league. You can tell as compared to Patrick Mahomes that Jared Goff would be much easier to defend. If these two statistical graphics were two companies rather than quarterbacks, we would say that Mahomes Inc. was a more healthy company. But we can see more than that in the statistics. We could dig down deeper into each area of the statistics and determine why or in what way the company is better. The reason we use financial ratios is that we're trying to draw some information from the relationships between the numbers. We're trying to tell a story. There are so many financial ratios. We're going to just try to boil them down into a few important categories and look at just a few crucial ratios within those categories. We're going to look at liquidity ratios, capital structure ratios, and asset management efficiency ratios. First, I want to just explain what liquidity ratios are. That's our first category we're going to talk about. Liquidity is how quickly your assets can be turned into cash. And it helps to answer the question, will the company be able to pay its bills as soon as they come due? We have several ratios we're going to talk about that help us evaluate liquidity. We're also going to talk about capital structure ratios. These ratios help answer the questions, how has the firm financed the purchase of its assets? Have they used debt or equity? And finally, in this presentation, we're going to cover asset management efficiency ratios. These ratios help answer the question, how efficient has the firm's management been in using its assets to generate sales? The two categories at the bottom will be talked about in the next PowerPoint. Remember that overall liquidity is analyzed by comparing the firm's current assets to the firm's current liabilities. We're trying to analyze how quickly the current assets are turned into cash, which helps us understand whether we can meet our obligations. There are 5 liquidity ratios, and they're listed here roughly in the order of their popularity and use. Let's go through each one of these. The first one is the current ratio, and of course it measures liquidity. It tells us a company's ability to pay its short-term bills. It's usually expressed as a 2-to-1 ratio, or a something to 1 ratio. So it's expressed as a whole number, and 2-to-1 is generally thought of as a good current ratio. Remember that we're comparing assets to liabilities, and that's how we determine the current ratio. The current ratio is calculated by taking current assets and dividing it by current liabilities. The acid test ratio, or quick ratio, is even a better measure of true liquidity. It takes inventory out of the mix. Inventory is not as liquid as some of the other current assets, so it makes a lot of sense. With the acid test or quick ratio, we're still looking at a real number like we did with the current ratio, but in this case we're looking more for a 1-to-1 ratio. That means that we would have $1 of current assets, not including inventory, for every $1 of current liabilities that we had. The formula to calculate the acid test or quick ratio is current assets minus inventory divided by current liabilities. It's exactly the same as the current ratio, except we subtract inventory from current assets. Another measurement of liquidity is how quickly we collect our accounts receivable. Accounts receivable should be turned into cash rather quickly, and this is the measurement of that. The average collection period measures the number of days that it takes to collect accounts receivable. What's a good measurement of this? If a company allows 30 days for their accounts for their customers to pay, then their average collection period should be near 30 days. The smaller the collection period, the better for cash flow. The formula to calculate the average collection period is accounts receivable divided by net sales, that's net annual credit sales, divided by 365. So what we're doing is taking our annual accounts receivable balance and we're dividing it by our daily sales balance. Doing that gets us an average collection period, telling us exactly how many days it takes us on average to collect our accounts receivable. We have another ratio that measures our accounts receivable. This one looks at it from a different perspective. It tells us the number of times that the average accounts receivable balance turns into cash. So for a company that allows net 30 on their accounts, net 30, remember, means that you're allowing your customers 30 days to pay the net balance on their invoices. That if you allow 30 days to pay, then you should be collecting 12 times a year. You should be collecting once a month. Companies would generally pick one or the other of these accounts receivable ratios and not necessarily use both of them. Accounts receivable turnover is calculated by taking our net annual credit sales and dividing it by our average accounts receivable balance. Our last liquidity ratio is a measurement concerning inventory. Inventory uses up a lot of our cash, and if we're able to sell inventory faster, we generally will have better cash flow. So this ratio helps us to understand the number of times that inventory is sold and replenished in a year. The formula to calculate inventory turnover is cost of goods sold divided by average inventory. Our capital structure ratios only have two ratios that we're going to be looking at. The first one is the debt ratio. The debt ratio compares the total liabilities to assets. We're trying to figure out the extent that the company is financed with debt. It's fairly sensible to say that 50% or less is good, but it does really depend upon the industry. We calculate the debt ratio by comparing our total debt to our total assets. The second and final ratio in the capital structure ratio category is times interest earned. I really like this ratio because it seems very practical. What we're trying to figure out is how many times can we pay interest on our debt out of our EBIT, which is our net income figure before interest or taxes. Since the times interest earned ratio is figuring out how many times you can pay interest out of EBIT, we just have to compare those two numbers. So we take earnings before interest and taxes and divide it by our current interest expense. The next category of ratios is for asset management efficiency evaluation. What we're trying to figure out here is how well our assets are producing profits. You've heard me mention that the only reason to purchase assets is for the purpose of increasing sales and increasing profits. These two ratios will help us analyze that. The first is the total asset turnover. Here we are calculating the amount of sales that are generated for every $1 that's invested in total assets. We want a return that is comparable to a return that we could get if we just invested our cash somewhere. The higher the return, the better. We calculate the asset turnover ratio by taking net sales and dividing it by the average total assets. We're looking at the same general idea with this second ratio as we did with the first, but we're just getting a little bit more specific. This time we want to know how well our fixed assets only generated sales. Our fixed assets are things like building and equipment, and they should definitely be working really hard in order to generate our profits. And finally, the last formula for this PowerPoint, the fixed asset turnover ratio is calculated by taking our net sales and dividing it by our average net fixed assets. Net fixed assets are our assets minus our accumulated depreciation.